Hey everyone, welcome back to Corporate Decoder. Today we're diving into KORU Medical's annual report. It's like checking your own health, but instead of a doctor we have accountants, and instead of your body it's their financial status. Prepare for a roller coaster because even though sales are up, profits tell a different story. KORU Medical makes infusion systems, those devices that help deliver drugs under the skin. Think of it like a precise, automatic way to get medication, often used at home. They focus on mechanical infusion products, primarily the Freedom infusion systems, which includes syringe drivers, needles, and specialized tubing. Their mission is simple: make life better for patients by delivering easy-to-use drug delivery systems for home use. This means patients can self-administer their medication, improving their independence and quality of life. Their strategy centers around a few key trends like increasing diagnoses of diseases needing immunoglobulin treatment, which uses donated plasma, expanding the uses for subcutaneous immunoglobulin known as SCE, and of course patient preference for at-home therapy since it's cheaper and has fewer side effects than going to a clinic for intratracheal syrups. Their Freedom system is their main product. It's cleared by the FDA and certified in other countries to deliver drugs for conditions like primary immunodeficiency disease and chronic inflammatory demyelinating polyneuropathy, along with selected antibiotics. They sell their products mainly through a few distributors, a common practice in the medical device world. So specialty pharmacies get the advantage of remote inventory management and basically one-stop shopping. As of the end of last year, 6 distributors made up about 75% of their sales. One US distributor accounted for around 35% of their revenue. That means a lot of their income depends on just a handful of partners. KORU manufactures most of its pumps themselves, but relies on a contract manufacturer for most of their consumables. Specifically, Command Medical Products in Nicaragua makes a lot of their needle sets and tubing. Like any good technology company, they are investing in the future. Research and development is a big deal for them. Last year, they spent $5.30 million on it, a bit less than the $5.7 million the year before, focused on new innovations like a next generation system. Now let's move into risks, which is where it gets interesting. Every company has to lay out all the things that could go wrong in business, so investors know what they're getting into. These aren't just formalities, but potential roadblocks. One major risk is their need to constantly innovate. If they can't successfully launch new products or adapt to changing technologies, their products could become outdated, hurting their revenue. They depend on a steady supply of drugs that their devices administer. If anything disrupts the drug supply, like contamination, or if the FDA changes the drug's approved uses, sales could drop. A big regulatory hurdle is coming up in Europe. They need to comply with the new medical device regulation by December 2028, which requires significant investment. If they don't, they won't be able to sell their products in the EU, which would hit their revenue hard. Manufacturing is another key risk. Command currently makes a lot of their consumables, and any interruption there could hurt their ability to meet customer demand. This is particularly dangerous since Command is based in Nicaragua. Of course, the global situation is always a concern. Events like the COVID-19 pandemic can negatively impact their business, delaying procedures and reducing hospital purchases. They face tough competition from other medical device companies, some with much deeper pockets. If they can't compete on features, price, or innovation, they could lose market share. Regulatory issues are a constant challenge. Medical devices are heavily regulated, and any misstep can lead to serious penalties, limiting their ability to market and sell their products. Healthcare policy changes and cost containment measures could pressure them to lower prices, which would squeeze their profits. Product quality is critical. Any issues could lead to recalls, legal claims, and a loss of customer confidence, all of which would be very costly. Like many companies, they need to attract and keep talented employees. Losing key personnel could hurt their ability to compete. Relying on a few distributors is risky. If these distributors change their purchasing patterns, their financial results could suffer. They could transition to direct customer purchase. However, customers may not want to purchase directly from them. Laws and regulations related to healthcare reimbursement are complex and constantly changing. If they fail to comply, they could face penalties and damage their reputation. They might need additional funding in the future, and if they can't raise capital when needed, they may be forced to slow down or stop product development and sales efforts. They are required to comply with certain financial rules as part of their credit facility. Changes in tax or labor laws could increase their costs and reduce their margins, particularly in manufacturing where they depend on low-cost labor. They're also exposed to foreign currency exchange risk, since a portion of their revenues come from international operations. Actions by activist stockholders could be a distraction. Their insurance coverage may not be enough to cover all potential liabilities. Brexit continues to create uncertainties that could affect their business in the United Kingdom. To really understand what's going on, we have to look at the numbers. Let's jump to the financial statements, their public float. The value of shares held by non-affiliates was about $83.5 million as of June last year. As of March, there were about 46 million shares of common stock outstanding, excluding the ones they hold themselves. Total net revenues increased about 18% to $33.6 million for last year. Their domestic core business grew by 12.3% thanks to increasing demand and gaining market share. Gross profit increased almost 28% to $21.3 million thanks to that revenue jump coupled with better profit margins. Their gross margin increased to 63.4% driven by manufacturing productivity, better product mix and higher prices. Selling, general and administrative expenses were up about 6% to $21.6 million, mostly due to higher compensation-related expenses. Research and development expenses went down a bit to $5.3 million, mostly because of timing and also severance. Now for the bottom line. Their net loss decreased $7.7 million, mostly driven by less operating losses. Their cash flow from operations tells a similar story. Net cash used in operating activities was $0.3 million. This net cash usage was primarily due to the net loss of $6.1 million due. So what does all this mean? Well, KORU Medical is facing a number of challenges if they need to attract new talent or they risk falling behind their competitors. If you don't have good talent, you can't innovate. If they can't compete, they will make less money, and that will all result in your stock value going down. Nobody wants that. A similar story is with the FDA regulation. If they don't maintain their current FDA certificates, their operations are going to crumble. The same story as above repeats itself. But the main risk is the dependency on suppliers and few distributors. The key numbers to focus on for me is their net losses and very slim profits. Thanks for watching. If you found this breakdown useful, hit that like button, drop a comment with your thoughts, and subscribe for more deep dives into the world of corporate decoding.